Good morning, everyone. Thank you for joining this webinar as part of the True Blue series. We'll be looking at life insurance sector today. It will just be a primer of sorts, just a basic introduction of the life insurance sector. We'll get started. So, life insurance in India is a combination of three different products, but we can broadly classify into three. First is savings, within which savings also consist of another three segments of products. First is unit-linked investment plans, often known as ULIPs. It combines investment with insurance. So it's a combination of a mutual fund with some life insurance cover on top of it. That's ULIP. Second is non-participatory products, shortly often called as non-par. Third is participatory. The difference is that in non-participatory, the benefits are guaranteed at the start of the contract. The customers pay a premium for a certain period, post which the customers will receive a fixed guarantee periodic payouts, or the customer can also choose for a lump sum payout at the time of maturity of the contract. For example, if you want to pay for your child's education, college education, when they turn 18 or 17, you can start such policies when they're anywhere from 5 to 15. So you can have a long duration product which will give you a lump sum amount when they need it for their college education. And this participatory product, it's a product where the 90 to 95% of the fund surplus, whatever bonus and the fund generates, that's distributed to the policy holder and not the shareholder. These products have a minimum guaranteed amount payable on either on maturity or on death, with the upside shared by way of bonuses, timing of which is at the discretion of the insurer. So the insurer can decide whether to give the bonus every year or every 4 years and so on and so forth. At the time of the signing the policy itself, you'll know when you are eligible for the bonus amount over and above a certain minimum guaranteed amount. Second is the protection category. I think this is the pure life insurance product because it only insures you for the loss of life, and it doesn't cover any sort of savings or investment. This is not a savings or investment vehicle. This is just a pure life insurance product. Let's say today, every year, you keep paying a premium of 30,000 rupees for a cover of 1 crore, just a rough estimate. Okay, so let's say something happens to you. Your family is eligible to get 1 crore at the time of the event, but you keep paying only 30,000 rupees per year. You won't get this premium back, but off late insurers have started giving an option called return of premium, where some amount of the premium that you pay will also be returned back to you at the time of the event or maturity. But because of this element, the upfront premiums that you pay have gone up. So it makes sense to stick with a pure play protection policy without any return of premium or any sort of that kind. The final product is the pension or the annuity, where people are paying money today to get payments long term to fund their requirement. Because once you are retired, you don't have a regular source of income. All you'll be left with is your insurance and savings or mutual fund savings that you'll have. But mutual fund savings will be riskier because there is a risk of losing your capital in some cases. So you need a secure, safe product which is similar to FD but slightly longer in term, because FD rates you can lock in for 5-year period, but annuity you can lock in for 15, 20, 25 years as long as you need at a certain fixed interest rate. So every year you will get some sort of income through these pension or annuity policies. So these are the three broad categories of life insurance products in India today. But the margins are significantly different in each of these sectors. We looked at ULIPs, which is linked products, which is where You will get some amount of some insured, some assured on the event of death, but most of the amount that you pay as premium will be invested in a fund, which is very similar to mutual fund. So it will have asset management fee, asset allocation charges, admin charges, over and above the mortality profit. But given insurance portion is very small, the margins are also very small, very low in this ULIP product. So the margins, according to industry estimates, are high single digits at best. And in par, 90% of the surplus is shared with the customers as a bonus. Okay. So that's why, again, the margins are lower in par. So if you want the insurance company to increase its margins, the overall margins, we look at what VNB is, value of new business margins. They'll have to move towards more and more of non-par savings products or for the protection products. Because if, as you see here, protections is the highest margin product of all, as high as 80% margins insurance companies are making. So any insurance company with a higher share of linked or par will have lower margins, which is the case with LIC today, and LIC is trying to move towards non-par products and protection products. But someone like even ICICI Prudential until a few years ago was having almost 50-60% of the product mix in ULIPs. And in the last few years, they've tried to bring that down. It's close to 30-40% ULIP now. Rest, they've tried to move towards protection annuity to some extent. So this is the broad breakup of the margins of each of these products. If you have any questions here, we'll take it at the end. I know you might have some. So it is also visible in data, although these are broad estimates because companies don't give product-wise margins, but through some data we can guesstimate this margin. For example, if you see the product mix, this is for ICICI Prudential. If you see, they had 43% linked product mix, which is ULIPs basically, and because of this, but this 43% only contributes to 11% in terms of value of new business. VNB stands for value of new business, nothing but the profits, operating profits that the life insurance company makes every year. Despite contributing 43% of the premium mix, it contributes only 11% of the margin mix. For example, if you take protection, it's only contributing 17% of the product mix, but it's contributing as high as 50% of the overall operating profits. So in a way, you get a sense of the margins. Linked or ULIPs is at the bottom end. Par is also towards the bottom end, but slightly better than ULIPs. Non-par is higher than par. Protection has the best margins. This is the broad breakup of the product mix and how the margins play out for each life insurance company. So the life insurance opportunity in India, right? So if you take, I think I keep saying that we've just gone from being a teenager in life insurance to a young adult or a youth, because life insurance was open to private only in 2000, around at the turn of the century, 2000, 2001. Companies started taking private licenses. At the beginning, it was growing very fast at almost 21% CAGR between 2000 to 2010. Then there were some regulatory changes around ULIPs and few other regulations. So it kind of degrew between this period. And in the next subsequent 8-year period, it has again grown at 12% CAGR. Again, in terms of total premiums, I also tracked this metric closely. At an aggregate level, the industry itself is growing at 11, 12, 13% CAGR, which means efficient players within the industry can grow faster than the industry aggregate, right? That's the fair estimate or assumption to make. Despite growing at such rapid pace, the penetration insurance premium as a life insurance premium as a percentage of GDP is only at 3% even today. And assets under management, all the assets managed by the life insurance companies, which is being invested either in debt, equity, right? All of that put together is also will obviously track the premium growth that has been growing at 11% CAGR. And the sum assured, which is for every life, there will be a sum assured. For example, I have a 2 crore cover, which is a pure protection policy. So every individual will have his own policy, which will have a sum assured at the time of death. That amount will be paid to the nominee or the family of that individual. That has grown slightly faster at 15% CAGR, which means we Indians are taking more and more policies, but we're also taking higher sum assured because of inflation and so on. The sum assured need for the family and the individual keeps going up at a faster rate than the policies themselves. This is a broad history of life insurance in India, and that's why you can see the interest amongst investors and FI institutions too, both foreign and domestic, to look at life insurance because of this growth rates. The industry itself is growing at 11, 12, 13%. Again, we can classify the opportunity going forward in four broad segments. First is the savings, because today life insurance as a savings vehicle occupies only 18% of the total household financial savings in India. And second is protection. The protection gap, as in, let's say a family needs 100 rupees to survive post the death of the income earning member of the family. But we are only adequately covered to the extent of 20%. 80% of the need is still not filled. It's an huge untapped opportunity as big as 16 trillion US dollars. That's almost 4 times India's GDP. That's how the production gap is significant in India. Third is retirement. Today, only 11% of the working population in India has access to any form of pension program. If your company is providing, if you're employee, if you're a salaried employee, you'll have this EPFO and so on. Not everyone has access to this, so they can opt for, let's say, self-employed or some other types of professions people. They can opt for additional pension products through these insurance companies. Fourth is health. This is very interesting because this slide is taken from ICICI Prudential. Until few quarters ago, they didn't even have this opportunity. But what's happening is in the last 6 to 12 months, there has been various consultations within the industry where life insurers said that they are also interested in selling health insurance policies in addition to life. Until 2015 or 16, life insurance companies were allowed to sell health insurance products also. But because of a regulation, there came about a separate segment of general insurance where companies like ICICI Lombard and a new segment called SAHI, standalone health insurance, started selling health insurance policies, and life insurance companies stopped selling it. But there is a proposal for a new composite license or a new standalone license where anyone can do any line of business that they wanted. They could either do a general, they could do a health, or they could do a life, or they can do all three together. And life insurance companies, given they've experienced in mortality risks, which is also related to health in some way, right? They can also underwrite health insurance policies going forward. So this is going to be a new driver for life insurance companies if they opt to get a health insurance license going forward. So if you see our share of working population, that is working population refers to the age group of 25 to 59. That is expected to grow at 14% CAGR till FY30. That means insurance industry can grow at 14% if these estimates turn out to be true. And this is the broad breakup of the Indian household financial savings. If you see, life insurance has been very stable at 17 to 18%. Which means this is not declining as expected because the hit is being taken by the currency and deposits. That is, people having savings account with the banks has gone down significantly, and this gray portion that you see has taken a bigger pie, and also the orange portion that you see, which is investments. We'll see that in a bit. So this is the mutual fund industry's AUM as a percentage of bank deposits. That's gone from roughly 10, 11% to almost 25% as of the previous calendar year, despite savings being eaten up by mutual. More and more people taking their savings from bank accounts and deploying it in the mutual funds. That has not impacted life insurance premium because the share of life insurance premium has been consistent in the last 10 years. So they've been growing at the rate, savings have been growing, and they've also been growing slightly faster than the deposits growth rates. And also, the one particular reason for this is that why life insurance companies weren't affected is because of this product called unit-linked investment plans. Because at the end of the day, whatever premiums you pay will be invested in some fund. It will not be your typical mutual fund, but these life insurance companies maintain their own investment funds where they deploy these funds. So, for example, this is HDFC Life's product mix. ULIP was only 19% of the total mix in FY23. That has jumped to 35% in FY24 and 38% in Q1 of this financial year. Because markets have been going up, apart from investing in mutual funds, Indian savers are also preferring unit-linked policies because, in addition, you also get your mutual fund kind of returns, albeit slightly lower, let's say 10 to 12% CAGR, but you also get the added benefit of your protection cover. So there'll be some amount of sum assured at the event of, say, death. So Indian savers are indeed moving away from deposits, but mutual fund is not the only beneficiary. Life insurance companies are also benefiting because of the unit-linked policies. Of course, this does come with a risk. That risk is, so this is HDFC Life's overall APE. APE is annualized premium equivalent, and VNB is value of new business. For example, in Q1 FY25, the ULIP mix grew at almost 80-90% for HDFC Life, whereas the overall APE grew at 20-25%. Okay, but despite this huge growth, the margins have taken a hit. You can see that from a peak of 26%, 27%, it's now come down to 25% again because we saw the jump in the ULIP mix, ULIPs in the mix going up from 19 to it has almost doubled. So that has taken a hit. HDFC Life has taken a hit on margins to compensate for the growth in the premiums. I just wanted to highlight that although they are benefiting from the financialization of India's savings, they take a hit in terms of the margins. First opportunity was savings. Second opportunity is protection. Today, roughly only 15% of the addressable population is covered by retail protection policies. The rest are covered by other policies, which we'll see in a bit. But if you look at sum assured as a percentage of GDP, we are only at 21%. And if you take our neighboring Asian countries, let's not go to the developed ones, let's look at someone like Thailand. Thailand is at 140% sum assured as a percentage of GDP, indicating a significant growth potential for sum assured in India. Protection gap, this I talked about before. So I'll explain what this is. Let's say today you need, so at the bottom is the ratio. Protection gap is nothing but ratio of protection lacking by protection needed. As I said, India's protection gap is almost 83%, which means, let's say, once the income earning member passes away and the income for the family stops one fine day, suddenly, right? That family will need, let's say, for example, 100 rupees to spend the rest of their life. But today, they are receiving only 15 to 20 rupees at an average level. Some they don't receive anything because they'll not have policies. So there's a gap of 80 to 85%. Right? This has to be narrowed down to the levels of the other even if you take developing economies like Thailand, which is at 71%. So this gap has to narrow. And once we become more and more developed, this gap should tend towards 50-55% ratio. This is slightly dated because this data is from 2020. The gap has indeed reduced post-COVID, but I think we still have a lot of work to do on this regard. So if you take the sum assured, and let's say our GDP grows at 8% and your sum assured grows at 20% CAGR, which is situation A, right? Even if we grow at 20% CAGR, our sum assured as a percentage of GDP will only be 65%, which is still half of South Korea, more than half of Thailand and Malaysia. And let's say we grow at 25% CAGR for the next till FY35, and GDP grows at 8% CAGR, okay, slightly faster next few years, and then tapering it down to 8%. We'll still be only at 107% sum assured as a percentage of GDP, right? So what this indicates is even if new policies don't grow, existing policy holders will itself will try to increase their sum assured. Let's say I'm at 1 crore, 2 crore. I might want to increase my sum assured to say 3, 4 crores 5 years from now, 10 years from now, right? Every family will need to have a higher sum assured because of inflation and other factors. So that was sum assured. Now, if you look at the policy count, let's say sum assured is growing at 20% CAGR. New policy count will roughly grow at mid-teens, which is 13, 14, 15, 16%. So even if we grow at 15% CAGR, at the end of FY35, we'll only have 29% of India's addressable population will be covered by FY35. But let's say we grow at 20% CAGR in new policy counts. We cover more and more new lives and individuals. We will be able to cover 41% of the total addressable population. That's the opportunity ahead of us. And in addition to pure protection, let's say you take a home loan to buy a house. So you will mortgage the house, you take a home loan from the bank to pay the developer or the builder, right? So in addition to taking loan, the bank will most likely to sell the credit life protect, which means let's say something happens to you, the bank will be at a loss because you'll not be able to pay the EMIs on the home loan. So in order to protect themselves, banks sell these credit life protect policy, which is similar to your protection, your term insurance or protection policies. So that's growing at a CAGR of 16% roughly, 16 to 17%. So this will also add to the life insurance premium pool and thereby the profit pool. And third opportunity is retirement. Today, so we saw that our working age population is growing at fast rates. So today's age bucket of 25 to 49 is seeking wealth creation. But as and when this bucket keep aging, let's say in the next 25 years, that bucket will move to the starting of that bucket itself will be 45. So this 45 to 70 age group bucket will be seeking annuity income going forward, right? So today they'll have regular cash flows, and all of that cash flows they'll invest in wealth creation. But once they're close to retirement or retired, they'll have to protect that wealth, the corpus that they've created, because they can't invest all of that in the markets because the equity is very volatile. So you'll need to have some kind of protection of your corpus, which is it makes more sense to invest in debt and annuity pension products of these life insurance companies. Again, the same data, put it differently, all ages put together, the population will roughly grow at say 1%. So it will go from, if we are using 2022 as a base, it will go from 100 to 118. But the 60 plus population is going to more than double in the next 25 years from 100 to 234. So we'll be moving towards a Japan kind of demographic mix because our middle age today will become old age 20, 25 years from now. So that's the opportunity in retirement. Again, so the let's say today you have when you retire at 60, you get 100 rupees as you need 100 rupees to spend the rest of your 20, 25 years of life. But in India, today the gap is as huge as 96, 95 percent. Because Indians today have only 8 to 10 rupees for every 100 rupees that they need to spend their post-retirement life. So that's and that is growing at a very significant rate also at 10% CAGR compared to 2 to 3 to 5% in other developed countries. In India, only the gap is huge, almost a 10, 12x gap in between 2022 and 2050. And pension assets, which is an indication of how much the retired people's assets are as a percentage of GDP, is very low at 6.5%, which is half of where Brazil is at. And other developed countries at crazy numbers. USA is at 132%. And all these FIIs you see investing in India, they'll have some form of these pension funds coming to them, which they're managing and which they will allocate to equity. Okay, they are conservative when it comes to pension assets, but some of it is being today it's being invested in both in listed equity and in private equity as well, in addition to debt. So we'll also get to a stage where Indian companies or these life insurance companies will be managing pension assets, which can be invested in debt, bond markets, and even some of it can be invested in the equity markets as well. Health, this is the fourth opportunity, the final opportunity. Okay, so today, like I said, only 9% of Indians' population is covered by private insurers. 50% is covered by this data is from Niti Aayog. So 50% is covered by government schemes, and 10% is covered by state employee state insurance schemes. 30% of the uncovered population is still there's 30% of the population is still to be covered via insurance. This is a huge number. Let's say even if this 30% remains uncovered, some of this 10% and some of this 51% will want to have a private insurance cover because today, I think recently Maharashtra government announced uh, policy health insurance cover, I think up to 5 lakhs for every family in Maharashtra. Do you think 5 lakhs is a reasonable cover given the current hospital rates and medical inflation, right? So any family which feels that 5 lakhs is not an adequate cover will make use of this government policy, but will also look for a policy from a private player where they can increase their coverage from, let's say, 5 lakhs to say 10, 15, 20 lakhs. People like most companies today, Star Health, ICICI Lombard, they all give cover up to 5 crore, 1 crore. 1 crore has become like this comprehensive health insurance policy is being given at 1 crore. Right. So here again, just similar to sum assured in life insurance, sum assured in health insurance will also keep going up because government can only give you a minimum sum assured, let's say 5 lakhs in this Maharashtra government's case. So this 9% covered by private insurance should go up over the next few years. We'll move on to valuation. So, life insurers' profits are evaluated based on concepts like VNB. VNB stands for value of new business, ROEV, return on embedded value. EV is embedded value, rather than your regular EBITDA or PAT or ROE. Because accounting in life insurance is a bit tricky. I'll explain why. So customer acquisition costs are very high in year one. But the benefit of that policy is accrued to the insurer over long durations. It's because life insurance is a long duration product. Let's say I'm 32 years old. I've taken a term insurance policy for 60 years. So I've taken a 28-year policy. I took it a few years ago, but I still have 28 years left in my policy. But the cost that the life insurer paid for its agent would be in the first year itself. It will be captured in the P&L also in the first year itself. It will not be spread across this 28-year period. That's why even if your profits are spread across these 28 years, but your cost is considered in the year one itself. That's why PAT is not a very good estimate. This is because the accounting standards do not permit amortizing customer acquisition costs over the life of the contract. So if a insurance company is growing faster, it makes more sense to not look at reported profits. It will obviously be very lower because if you're going faster, you'll be paying, you're basically paying more commissions to the agents who sell these life insurance policies. And similar to EBITDA in your regular companies, in life insurance, there's something called as VNB, value of new business signed up. So this is the expected profits insurance companies expect to make on new business over the life of the contract. Let's say they sold a policy to me for the next 28 years. The profits that they'll get in the next 28 years, because every year I'm going to pay a certain premium. I renew my policy every year, right? So they'll get some premium from me every year for the next 28 years. So all of that will be discounted to today's value, which is basically NPV of my policy for ICICI Prudential, right? So that's called post all the expenses. So that's called as VNB, value of new business. So for every policy that they sell, they'll arrive at a net present value of that policy. All of this clubbed together is called as value of new business. This is, mind you, this is premiums minus expenses, and so net of all expenses discounted to today's value. And they also report something called as embedded value, which is net present value of all future profits, all businesses in force, not just that particular year's VNB. They would have done some business over the past few years, right? So all of the profits, net present value of future profits of all of those policies that they've written in their history that are yet to expire will be added to the net worth of the insurance company. We'll see this in a pictorial way so that you will understand better. So instead of return on equity, which is nothing but return on your net worth, it makes sense to look at return on embedded value for life insurance companies to estimate the capital efficiency of the business. So this is how a typical embedded value will look like. So the blue portion here is your net worth, which is your equity capital plus all your reserves that you have generated till date, right? All the booked profits. Okay. Value of in force is that is the is equal to VNB n minus 10, n minus 9, n minus 8, n minus 1, n minus n 0, n plus 1, n plus 2, which means for all the policies that the insurer has returned in its life, and if it's still in active policy, which is premium paying every year, so all of that will have to be discounted uh, in value of in force. So some of it, all the past policies would have already been flowed through the P&L. That will reflect in adjusted net worth. All of the N plus 0 policies that is yet to be recognized in the P&L. So that will sit as value in force, which is VIF. So most companies give the breakup of the embedded value, and this will be too technical to go in to details, but this is how it looks like. You start with the opening EV for a particular financial year, in this case FY 24, and then you unwind the profits for that particular year, right? So we are going from N minus 1 to 0. So you take the profits from VIF and transfer it to adjusted net worth, because you are realizing one more year in all the sold policies. Okay, so this is basically your discount rate. So your opening EV, let's say you've discounted all your future profits at say 7-8%, which is roughly similar to your government GSEC 10-year yield. So every year you unwind 7% of your VAF, you basically transfer it from VAF to adjusted net worth. And there'll be some operating assumption changes. And then this is your new policy that you write for that particular year. So these are the two big contributors of EV for a life insurance. One is unwind rate and one is value of new business margins. And to put it in a slightly better way, right? So this is for HDFC Life. So every year, let's say for FY24, HDFC Life sold annualized premium equivalent policies worth 13,300 crores roughly, of which for all the new policies that they sold, the value of new business, that is the net present value of the profits that they may make for the new policies sold, is roughly 33,500 crores. Roughly 26% is the value of new business margin. This will depend. So this we have already seen. This margins will depend on product mix. If they have sold more ULIPs that year, the margins will be lower. If they have sold more protection, the margins will be higher, and so on. And then you have the unwind rate. So basically, from your N-1 policies, you realize you basically apply the discount rate, and see this rate of unwind is the discount rate. So I'm taking 8.2% of my embedded value and then recognizing it as profits for that particular year. This is basically revenue recognition or profit recognition. And then there'll be some operating assumption changes, some operating variance. These are very technical details, but I'll just maybe touch upon it a little bit. So companies make a lot of assumptions when they arrive at embedded value. One is persistency variance, which means, like I said, I am continuing my policy, renewing my policy every year. Let's say, what if I stop renewing it at the end of second year, or third year, or fourth year? So for each of these years, life insurance companies maintain a persistency ratio, which means at the second year, close to 90% of the customers renew their policies. At the end of fourth and fifth year, it drops down to 70%. So only 70% of the customers renew their policy at the end of fifth year. So each company will have a different persistency ratio. Based on that, the assumptions will change. Mortality and morbidity. So let's say every year, life insurance companies will have a assumption that certain percentage of people will die that year, and they'll have to pay out the amount. And they also make some expense assumptions. Let's say this year they're going to spend so much amount on commissions or so much amount on employee costs. They'll make some assumptions to arrive at the embedded value. If there are changes in that, they'll make these operating assumption changes. And versus these assumptions, what is the actuals? If there is any change in the actuals, then that is reported as variance, operating variance. So I told you about AP, I explained VNB, EVOP, which is embedded value operating profit, is nothing but the sum of VNB, which is 3,500 crores, the sum of plus unwinding, which is 3,200 crores, plus any operating assumption changes. HDFC Life has been one of the most conservative insurers in terms of assumptions. They haven't had any significant assumption changes except for FY23. But if you look at someone like ICICI Prudential, it will be haywire. It would have been positive in some years, it would have been negative in some years. Operating variance is okay because you will enter a financial year based on certain assumptions, but the assumption need not hold true always. So there'll be some operating variance always. So all of these four components put together is what makes EVOP. And now, if I divide this EVOP by the previous years or the opening embedded value, that gives you the return on embedded value. For example, 6,923 crores divided by 39 crores is roughly 17.5%. So the return on embedded value for HDFC Life is roughly 17 to 18% ROE. So this is similar to your ROE. So let's say if you give ICICI Bank has 18% ROE, right? Close to 18%. So it's trading at 4 times price to book. So HDFC Life given it has 17-18% ROEV, can also trade at 4 times price to embedded value, 3 to 4 times price to embedded value. That's the broader summary. Today, it's trading at close to 3.2 times price to embedded value. Another simplistic way to estimate the ROE potential of life insurance company is to look at the net worth CAGR of these companies. For example, I've taken SBI Life and ICICI because HDFC had issued some shares to Excite for the acquisition, for the takeover of Excite's life insurance business. So that's kind of skewed. If you look at SBI Life, the rolling 5-year CAGR has now, post the high growth period, has now come down to 16 to 18%. So this is the intrinsic ROE of a proper, efficient, well-run life insurance company. ICICI Prudential is slightly weaker franchise because the net worth has grown at a CAGR of 11-12% in the last 5 to 7 years. But they're doing some steps to change this. By they were very ULIP heavy. Now they're trying to move to more protection heavy. They also had some issues with ICICI Bank not selling certain kind of policies because of all this one bank, one customer uh, policy that they have at the bank level. So they stopped selling some of their subsidiary ICICI Prudential's policies. Now they're coming out of all of it and they're trying to increase their ROEV. Two levers they'll have. One is obviously growth. The second lever is increasing their VNB margin. So this is the intrinsic ROE for life insurance companies. Obviously, every sector will have its own risks. So for life insurance companies, I've broadly classified them as three. I'll start with the bottom one, which is regulation. We've seen multiple regulations in the last few years. First, they capped ULIP, non-taxing exempted ULIP ticket size. Then they came to non-par ticket size, which where government said that above 5 lakhs, I'm going to tax you because some HNIs were misusing this product to exempt themselves from income tax. And not just that, even in terms of product design, IRDAI has taken a stance saying that insurance companies should pay a higher surrender value to customers when it comes to par products or par and non-par products. Okay, so regulation can come in any form, which is also linked to tax, which we'll talk about it. But another thing is regulation has also been favorable, where now they're allowing life insurance companies to sell health insurance policies also. Second risk is alternate products and channels. We've seen the growth of PB fintech, where which is it was till still pre-COVID, it was more an agent-driven business. So it was more push, a full sort of a product where you'll have to each agent will have to go to the customer's door and push the product rather than being a full product. The customer doesn't come in search of a policy. The agent goes in search of the customer for the policy. They were pushing the product. And now post-COVID and the advent of PB FinTech and other platforms, now you can just go online and if you just type best insurance policy for my age and so on, you'll get a comparative statement of the premiums that each company charges for a particular sum assured. So it is trying to become a more of a full product, at least in the term protection segment. Rest is still being majorly driven by agents and bankers. Next is tax, we'll see that. So today, life insurers enjoy a lower corporate tax, which is roughly 14.56%. Because in the last 20 years, government, like I said, we went from in 2000 was the life insurance sector was a newborn baby, and now it has become an young adult or youth because we are 24 years old when it comes to life insurance. So the government might rethink this low corporate tax rates for insurance companies. As of now, there is no talks or no proposal being made because government has a huge stake in LIC. It will not want to screw that up. So we think it's a low probability risk, but a risk nevertheless. So when the tax rate increases from 14.56% to the what level of 25%, the rest of the companies, that will be an impact on stock price and the interest rate risk. Because so let's say, how is a insurance company able to guarantee a certain return? Let's say if you today you go to take up non-par product, savings product, you will get a guaranteed 6%, 7%, 5% for a long period for 20, 25 years. FD is you will get only 5, 7 years at best. But insurance companies give you 20-year fixed returns. They are able to do that because they take your premiums and they buy derivatives of interest rates, derivative of debt bond products to save themselves from this mismatch, asset liability mismatch. So if the interest rates increase, it will have a negative impact on insurance companies. For example, a 1% increase in interest rate, this is for HDFC Life, 1% increase in interest rate will result in a negative 2.7% impact on the EV of HDFC Life. So if HDFC Life is trading at 3x market cap to EV, so it will have 3 into 2.7, roughly 7, 8, 9% impact, one-time impact on the share price if interest rates were to increase by 1%. So a declining interest rate scenario is good for insurance companies. Of course, you can debate this because their other income, the income from all the investments that they have made, will also go down in a declining interest rate scenario. So it's just not interest rates and income tax rate. There are multiple factors or metrics which are very sensitive when it comes to calculating the embedded value. The reference rate is the interest rate that we spoke about. And because some of these assets that life insurance companies manage is invested in equity, even if let's say there's a 10% fall in the market today, there'll be a 1.5% impact in the embedded value of HDFC Life. And if a life insurer has more and more of its AUM invested in equity, this impact will be higher. And these are the other metrics where insurance companies provide the sensitivity table for maintenance expenses, acquisition expenses, persistency, and so mortality. Let's say in COVID, mortality increased significantly. So the payouts for life insurance companies were very, very high. And they most of them posted losses. Tax rate we already saw. And this is for ICICI Prudential. We saw that HDFC Life will have a 2.7% impact on its EV if there is a 1% increase in interest rate. If you see here, ICICI Prudential will have a higher impact, 3.5%. It's all down to how they are managing risk, how much they go for reinsurance, and how much is the share of debt and equity, and so on. 10% decrease in equity values will result in a 1.7% decrease in the EV of ICICI Prudential. These are the broad risks in life insurance. Hope I was able to give some sort of introduction, basics to get you started on life insurance sector and analysis of the companies in the sector. I'm happy to take any questions. If you have any, please drop your questions in the chat box. I'll just give it a few more minutes before closing the meeting. If you have any questions, please post it in the chat box. So there's one question from Sai. So HDFC Life and other private insurers are valued at 3 to 4 times price to embedded value, and LIC at zero point 0.9 price to embedded value. Of course, there is over percent PSU overhang, but do you think it's very undervalued? It is undervalued. You will not know what the government is going to ask LIC to do. And also, I said that the par mix is very high for LIC. So if you'll have to look at what the ROEV of LIC is. And the significant reason why it's so low is it's because it has a very high par mix. But now LIC wants to increase its non-par mix and the protection mix. And if you see the recent interviews, they're also interested in health insurance market. So they have a huge base of almost, I think, 12, 13 lakh agents. Okay. And all of these agents are in some way or other selling health insurance also. They'll be associated with Sahis like Star Health, or they'll be associated with someone like ICICI Lombard, because there's this regulation which states that one agent can tie up with three life insurance companies, three health insurance companies, three general insurance companies. But if LIC gets into health insurance, the agents who are already partnered with other health insurance companies will now be forced to sell LIC's health insurance policy. I think they might enter the sector via an acquisition, but these are all very speculative speculation at best, because we don't know when the composite license scheme will be implemented, when it will be passed in the parliament, and if LIC will apply for it to get into health insurance, and will they acquire any company, any Sahi standalone health insurer to enter. So all of this is very speculative, and the uncertainties related to what the government will do regarding LIC. They'll be asked LIC to buy something or so on. So there are a lot of hurdles for it's not independent an entity which can think for shareholders. So it is undervalued to some extent, but not significantly, I would say, because of the ROEV structure of LIC. How many insurance company in RPMS, and what's your return expectations? So in True Blue, we have HDFC Life as a top weight, one of the top weight stocks, and we also have Bajaj Finserv, which owns BALIC, Bajaj Allianz Life Insurance Company. So we have exposures to through these two entities. We do not have SBI Life because, as a principle, we do not buy uh, uh, PSU owned or government owned entities in a True Blue portfolio. It's not like we will not buy. We need some evidence of independence or some evidence of visibility for us to buy a PSU entities. And also another thing is SBI Life. If you talk to, I don't know if if you've ever banked with SBI, you'll be forced to take an SBI Life policy if you're taking a loan. I have seen examples where the bank manager will tell you that if you take a 10 lakh endowment policy, I'll decrease your loan interest rate by 1% or 0.5%. So all these bank branch managers have fixed goals every year. Like they have to sell so much premiums every year, be it also SBI Life also has an exclusivity. SBI banks branches do not sell other company life insurance. They only sell SBI's life insurance policies. So these branch managers have goals to achieve every year. So they'll force you to buy a life insurance product whenever you take a loan. So we didn't like that sort of a business model. So that's why we're staying away from SBI Life. We feel that we have adequate exposure to life insurance via HDFC Life. How will the market share of LIC get taken up in future by the private players? If you take just the top four life insurance players and compare it in the last 5 years, I think it's gone from mid-teens or low teens. Now the top four companies almost have 20 to 25% market share. So they've been consistently gaining market share, and private players can be expected to continue gaining market share in the next few years also. What are the major risks for the insurance company? I just discussed that, sir. I had listed three risks. One is corporate tax going up from 14.5 to 25, interest rates increasing suddenly, markets falling suddenly. All of these are risks, but the interest rate and market falling is a temporary risk. A bigger risk could be from the form of reinsurance rates going up because there's a concept of reinsurance where some of the risks that these life insurers take, they'll pass it on to a reinsurer. If those rates go up, that's a risk. And global price tablet value is around 1.5. Is the current price tablet value for HDFC Life and ICICI overvalued. HDFC Life, you can argue it's overvalued, but ICICI Prudential, it's still at sub 2x price tablet value. So you're right that the global price tablet value is around 1.5. India also will tend towards this 1.5, but it will take some time. It will take some 20, 10, 15 years for all our insurance companies to trade around 1.5 price to tablet value because of the under penetration in India. Uh, and because I've also given you evidence as to how sum assured will grow at good CAGR, new policy count will grow at good CAGR, and how even government insured families will need some amount of private insurance too, because the government provided policies do not have adequate cover. Okay, that's why I feel that there's still some leeway for Indian life insurance companies to grow, and their structures within that HDFC Life and SBI Life will have 16 to 18% ROEV. iPru might have a 14% kind of ROEV. So that valuation gap will be there within the Indian life insurance players. Star Health future after composite license approved. This is it's still very unclear, sir, because let's say Star Health today has some 6 lakh, 7 lakh agents. I don't know how many of those agents are also partnered with LIC for life insurance. Once LIC gets into health, what will these agents do is still a very unclear situation for me. So I'll not want to predict what's going to happen with Star Health. They've been talking about doubling their premiums in the next 4 years. So they've been doing good growth in the last few years. They're also going to do good growth. Just that this element of LIC entering health insurance, I don't know how it's going to play out. I don't have the vision to visualize how it is going to play out. We'll have to wait and see how the policy is finalized. You're also forced to take SBI life policy even if you need a locker in SBI. So you enter a SBI branch, you'll be a policy will be pushed down your throat. Yeah, it is unfathomable. We don't know it. I mean, I will be completely wrong, and this policy of SBI bank branches will continue forever. But we don't want to take that risk because now, if you've seen the interviews, there was some communication. I don't know if it was from the RBI governor or from the finance minister, where they asked PSUs to be careful, cautious with selling policies to the bank customers. Many life insurance companies are available in the market. Is it easy to get new insurance license? Can we expect more M&A in future? How companies maintain their margin? Good question, sir. If we look at general insurance companies, we have seen a lot of these venture-backed, private equity-backed companies entering the fray, be it GoDigit or ACO and a few more. So general insurance is pretty or relatively easier to enter. But you haven't seen life insurance industry seeing a new player. You've only seen consolidation, right? HDFC bought Exide. So that's more. We can expect more M&A because companies which shouldn't be doing insurance got into it. So that some consolidation will happen. But post is composite license where government is thinking of low. So today to apply for a license, you need a certain net worth. government is considering lowering that net worth requirement to allow more and more players to enter. So that's again contingent on dependent on what the policy, eventual policy will look like. If the net worth requirement is lowered, we can see more and more new players entering, but it's a difficult business to do because my estimate says that a new company will break even in 7 years, at best 5 years. So it's a difficult business to be in. You need deep pockets, distribution strength to compete with the incumbents. Thank you, Sanjay. Thank you, sir. I have two questions. Can you explain unwinding concept again? I was not able to follow. Okay, so today, let's say you take a DCF, you project the cash flows for the next 10 years, okay? And you discount those 10-year cash flows to arrive at today's share price for any company, okay? Let's say today, I don't know if I have an example already. Just give me a moment. I don't seem to have that DCA, but anyway, I'll try to explain. So let's say today you discount, you're in year zero, you discount next 10 years of cash flows to arrive at today's value. Let's say you move forward 1 year, you will only now discount 9 years of cash flows, and you'll have to add the first year's cash flow to your value because you have discounted it. You have to remove that discount. That's called as unwinding when you go from year zero to year one in a DCF model. For example, we are at FY24 today. So FY25 future profits, ICICI potential will accrue at the end of the financial year, right? So we'll have to discount it back to today's value. But if we are fast forward 1 year from now, the discount that you apply to FY25's profits, you should take the full value and not the discounted value. So you'll add back some amount to your net worth or the embedded value. That's the unwinding concept. Countries like USA, the government pushes people to buy insurance somewhat mandatory, and people know that without insurance they cannot get treated. And so, is it fair to compare India with other countries? Of course, this is valid point. Forget US. You can take China. You can take Vietnam, Thailand. All of them have government uh, insurance. Okay, so they went from 20-30% coverage, insurance coverage to 60, 70, 80% coverage in a short time because there was both China and I think it was Vietnam. Both of them had government policies and schemes. We also have it. Our PM Prime Minister has introduced multiple schemes to cover our citizens. That's why you see that today 50% is our population is covered by government schemes. I'm saying that is not enough. So they'll tend to take more private insurance policies also over and above the government policy. How do we find out if the insurance company is undervalued? So it's very difficult. So for example, from being a very high ROEV company, ICICI Potential, because ICICI Bank stopped selling few products, they took a big hit, and their structure also took a hit because they were not growing faster, and they are also very ULIP heavy, so their margins were lower. So today, ICICI Potential uh, is trading at roughly 1.7 times price to emerald book value. We feel that still now it has gone up. It is significantly up in the last post budget. It started rallying, but we were very bullish on ICICI Prudential because it was very cheap. It was close to 1.6, 1.7 times price to emerald value, and we felt that the company is doing enough changes to increase their ROEV from the current 13-14% levels to, let's say, it might not hit the SBI Life or HDFC Life ROEV of 17-18, but it can get to 15-16% kind of ROE. So that demands, let's say, a price to earned value of 2x at least. So there was some comfort on valuation and some comfort on ROE going from a lower level to a higher level. Now I think it's fairly all insurance companies are fairly valued. Only at times of issues, trouble, you will get opportunity in such sectors. For example, ICICI Prudential went through an issue because of ICICI Bank. Otherwise, you will not get an opportunity. And also, post the budget, HDFC Life fell to almost 500 levels, I think, if I remember correctly, because we had a regulation where government said that above 5 lakh ticket sizes in par non-par products will be exempted, will not be exempted from tax. You'll have to pay tax on those gains. So that led to a significant fall in all insurance companies, and HDFC Life, a very good franchise in life insurance, fell to as low as 500. So that was a good opportunity to buy. So whenever there is a regulation-led or some event-based falls in insurance companies, that's the only time you get an opportunity. Shall we expect another Berkshire Hathaway from Indian insurance industry? Okay, so fair question to ask, but it's difficult because you can go through Berkshire Hathaway's annual reports and they give an update on Geico. Geico is their general insurance company. So, like I said, US insurance industry is 100 years more or old, if not more, at least 75 years old if you take Geico's history. Okay, so they are a old human, and Indian life insurance industry is a young adult. We'll have to look at it that way because the losses. So, for example, Berkshire Hathaway in the last 20 years almost had some 15 years of underwriting profits, and within that they had some 7 to 9 year period where they every year they made profits. So US is a more mature industry. India is still a developing industry. We've gone from being a teenager to an adult, a youth now. Maybe 10 years from now, we can see general insurance companies making underwriting profits also. Today, they're making underwriting losses, but it will take some time for us to go the Berkshire Hathaway route or the Geico route. Insurance industry is defense or cyclical or semi-cyclical. Cyclical. So people say pharma is defensive, banking is defensive. I am from the camp where everything is cyclical. Every business is cyclical, just that the cycles will be longer or shorter. What is the USP for a company like HDFC Life over its competitors? One was distribution, which is being attacked now by the likes of Policy Bazaar and so on. And second is product innovation. For example, HDFC Life has a term plan called Click to Protect. That's one of the best in the industry, and they also have a few other Sanjay Plus, which is a par non-par product. So both these products are very good in the industry. You can talk to any agent, and they'll also tell you that these products are very good. So product innovation, where they have some features within the product that the other competitors don't. So for now, I think it's innovation in product and distribution, which is what HDFC Life is known for. Of course, they also have they did take a hit when HDFC started selling other uh, policies also. But now, post the merger, now that the bank owns HDFC Life, the share of HDFC Life within HDFC Bank has gone up to 60-70% levels. So that they have a huge advantage with their parent being the largest private bank in the country. So in addition to agents, the banca channel, which is the channel through which banks sell the insurance policy, is called banca channel. They also have a very strong banca channel because of HDFC Bank parentage. I think we've reached uh, the end of. I think I was able to answer most of the questions. Will Geo Financial disrupt insurance industry? They've just I think they've applied for their distribution license. Maybe I don't know if they're looking at the manufacturing license. If yes, yeah, there will be some disruption because they're coming with the deep pockets, and we've seen that in general insurance industry where Go Digit uh, and Acco, not just deep pockets, because of their irrationality to grow faster, they disrupted the industry profit pool. They also gained market share, but they disrupted the profit pool. So that is definitely a possibility. Insurance industry is not a multi-bagger, so it's a compounder at best. You buy it when there is an issue. Let's say today in the next budget they announce they increase the tax rate for life insurance company. They'll all fall some 10-20%. Makes sense to buy after that, and then you can compound your money at because the industry itself is growing at 12-13%. So you can compound your money slightly better than that. It's 12:16. I think we'll close it here. Thank you all for joining and for all the questions. Hope I was able to add some value. We'll keep doing these webinars every week. And we also upload it to our YouTube channel. If you want to go back and see some parts of it, please check our YouTube channel. Thank you. Bye bye and have a good weekend.